A very good evening to all of you. It's my pleasure to have you all both on the Zoom platform as well as on the YouTube live link in the new year, and wish you a very, very happy new year. Let's hope that the year 2021 is much better and we come back to normalcy. I hope all of you are safe at your respective locations and feeling healthy. And of course, we are all aware that the COVID is slowly abating, but it is very much there. So would request you to keep yourself safe and maintain the social distancing and the other norms prescribed by the government. As far as the topic today is concerned, what we've seen is that of late, the GST law has become a little bit more complex day in and day out. And in fact, in the last week of December, there were a series of notifications which complicated the GST law slightly more than what it was already there. Maybe it does not apply to everyone, but yes, there are certain anti-avoidance provisions which have been created. Will definitely catch the people who are doing wrong things. But even in case people are doing genuine things, this can create some difficulty in case of genuine errors. And we therefore felt that it is important that all these changes be communicated to you all. We have already sent you the newsletter on this regard, but I thought a personal meeting like this could really be helpful in all those areas. And what I will also try to do is pick up some of the recent changes and developments so that we have a little bit of a more comprehensive view on the entire aspect as such. We'll try to spend around 75 to 90 minutes on this entire process, and thereafter if there are questions you can use the chat window and put those questions in the over there, and we'll try to address those questions before we wind up the session. Those who are watching these on YouTube live, will request you all to please put your questions on the WhatsApp group or on the Zoom platform, because we may not be able to monitor the questions on the YouTube live. So with that little bit of a preliminary remarks, let me take this opportunity to start the session right away. And GSTA, over the last 3-4 years, we have discussed lots and lots of things about it. Way back in 2016 and 17, lots of acronyms were created for this goods and services tax. Somebody said it's a Gabbar Singh tax. Somebody else said it's a good and a simple tax. Uh, if someone looks at the presentation today, one will really doubt whether it really has any elements of simplicity. Most of the people attending this program are handling the day-to-day reconciliations, and it appears that these reconciliations never seem to end. Where is that simplicity lost? And I think today's session, the entire theme is on trying to understand where that simplicity is lost and whether we and the government, both the stakeholders, can act in concert with each other so as to bring back the much desired simplicity. Now, with that background, let's start with the outline of the presentation today. All of us are aware that whenever you're looking at GST, there are 3 or 4 building blocks to GST. You pay a tax on all your outward supplies. There is a value, there is a rate, and when you multiply your value and rate, apply the place of supply rules, you get the nature of the tax as well, and accordingly you determine your output tax. From your output tax you get input tax credit, and maximum discussions today will be around this aspect of input tax credit, and that's where the major challenges have been. On the inward supplies, on your expenses, on your purchases, the suppliers would in routine course collect and pay the taxes, and that taxes which are paid by the suppliers are available to you by way of a credit. This is known as input tax credit. There have been certain uses and misuses, and certain fears of misuses which has complicated the entire scenario over here. In certain cases, of course, the government found a simple way out to prescribe what is known as reverse charge mechanism. It was there in service tax and it has continued in GST. We also saw the scare of URD RCM for 3 months, but thereafter, from October 17, it has been done away with. But other RCM, like if you are making payment to a GTA or an advocate, there is a reverse charge mechanism. We are aware that we have to first pay the tax ourselves, and once we pay the tax, we can also claim the input tax credit. So it is a plus and a minus game. It does not really impact our profit, or it does not really impact our cash flow. So these are, as far as the overall compliance is concerned, you have an output tax, you have an input tax credit, you have reverse charge, and of course you can use your input tax credit to pay your output tax. You cannot pay reverse charge mechanism from input tax credit at all. Of course, these are all very basics, but just when the recent GST audit season was concluded, we found that there were a few errors in this regard. So I thought maybe we can revisit the basics and just rebrush it in one or two sentences. Thereafter, we'll talk a little bit about the changes which have happened in the processes of registration and the return filings, and the numbers keep on increasing. And earlier you had a 2A, now you have a 2B, and we'll try to understand all those documents and the procedures in that regard. And thereafter, we'll talk about a lot of activism from the department in terms of assessments, both in terms of proactive anti-avoidance measures as well as the post facto assessment by way of an audit or a scrutiny. So that is how we'll try to talk about today, and these are the five broad sections in which we will talk about. So let's begin with the first part, which is the outward supplies. And friends, many of you who have seen my earlier slides or presentations must have seen this slide in a slightly different format, but something like this coming up in the earlier presentations as well. I always believe that certain things, yes, they might have been talked about once, but at periodic intervals, they need reinforcement. And therefore, maybe we'll spend 2 to 3 minutes in trying to understand how your taxes on outward supplies need to be discharged. And when we do a GST audit, or even when the department is going to do the audit, what it's going to primarily do is it's going to rely on your financial statements. And that's what we also do. We pick up our profit and loss account, take up the sales, take up other income schedules, because each of them would be characterizing some transaction as a outward supply. The outward supplies are not only characterized in your income accounts, but sometimes they come as credit entries in your expense accounts. They might be appearing as a reduction in expense, especially in cases where there are taxable reimbursement of expenses, or there are cost sharing arrangements between groups, or there are recoveries from employees or clients which are liable for GST. So one will also have to look at the expense side and the credit items in the expense side. From the balance sheet, you typically have deductions from fixed assets, which comes into your sourcing of your outward supplies. And there are various reimbursements which might not come through the P&L expense account, but might come through the balance sheet. And of course, when we are looking at the reconciliation, we also have to keep in mind the unbilled revenue as well as the advance payments which come in the balance sheet, and make adjustments for that. Now, this is as far as financial statements are concerned, but there are also certain transactions which do not get recorded in your financials or get knocked off in your financials, and at the same time might be liable for GST. And two classic examples which we can think about is the concept of branch transfers, both branch transfer of goods as well as services, as well as a scenario where you have a reverse supply, meaning there is a reduction in your expenditure or a reduction in your purchase, but the vendor says that you please raise a commission invoice and or a marketing invoice and charge me GST. So these are known as, typically popularly known as, reverse supplies. So these are the various sources from which the value on which you are required to pay GST will apply. More or less, organizations have automated these processes. In ERP, you might have a tax code, and basis the tax code, you will have a tax GL, and that tax GL will then be reconciled with the actual tax payments, and that's how typically one gets an assurance that the taxes on outward supplies have been correctly paid. Now, when we are talking about all of this, we also have to look at the dimension from the GST perspective, because under GST law, and especially when you are filing your GST returns, GSTR1 as well as 3B and your GSTR9, you might see that there are various classifications of these supplies. And it's important to know that we have to classify those transactions in the correct tables. In the past, we have seen cases where just a small clerical mistake of putting something in a wrong table has then resulted in a sort of an unresolvable deadlock, and maybe at times loss of refund or delay in getting of refunds. As far as the returns and the GST treatment of each of these supplies is concerned, those supplies typically get classified into taxable supplies. Most of those supplies would be taxable on forward charge basis, but then there are examples where there's a reverse charge mechanism. So that will also come into place, where you are providing an output supply, but it is under the reverse charge mechanism. There are taxable supplies which are zero rated. After 3 years, we all understand this concept of zero rating. It typically includes your exports of goods or services and supplies to SEZ units. You have a choice over here of either making a zero rated supply on a payment of tax and thereafter a subsequent refund, or if you have a letter of undertaking, which is very easy. If you have a letter of undertaking, then you can make a zero rated supply without payment of tax. In your returns, you are also required to disclose the value of your exempted supplies, This typically would include examples like your interest, which is a consideration for lending of money. It could be a commission on an agricultural produce or any specific exemption notification which might be applicable to you. It also includes non-GST supplies transactions which are not governed by the GST law. For example, your supply of alcohol in case of restaurants and hospitality sector, or those products which are not into the GST at all. At the same time, there is something which is not treated as a supply at all. For example, if there is a capital account transaction, a loan or something like that, it will not be a supply at all, and the conventional meaning of supply itself will not cover it. Also, you have scenarios where Schedule 3 defines certain transactions to be neither a supply of goods nor a supply of services. So, if there are transactions of those nature, then they are treated as not a supply at all and accordingly disclosed in the respective returns and the supply documents. Now that takes me to the third and the more important aspect of today's discussion, where we'll spend a few minutes more, is on the nature of the paperwork. So while we the first two columns here talked about the macro level understanding of outward supplies, at a transactional level, what are the types of documents and the compliances which are expected in the GST law? That is what the third column talks about. And as we all know, that whenever there is some transaction on which there is a tax impacted, taxable supply being made, either a normal taxable supply or a zero rated supply, you are expected to issue a standard document which is known as a tax invoice. Now, when we say tax invoice, it has a very clear connotation. And it has a title of a tax invoice, and there is a rule 46 which defines what all things will be a part of the tax invoice. There is also a timeline of tax raising a tax invoice, and we've discussed all of that. But what has happened in the recent past, and it's also happening, is the fact that this entire concept of tax invoice is sought to be automated or controlled by the government through a concept known as e-invoicing. Wherever the e-invoicing has been applicable, we have reached out to the respective clients and we have done individual one-on-one sessions with them. But despite that, we've tried to cover 2 or 3 slides of e-invoice immediately after this slide, so that we have a clarity on what is e-invoice and how is it applicable and what are the key changes which happen, because that tax invoice now has to be compulsorily in the format of an electronic invoice. As of today, it is applicable for entities having turnover above 100 crores. Recently, they have said that we will make it applicable to entities above having turnover above 5 crores for from 1st of April 2021. So that's not very far off, and there are certain technology related changes which might be required because of that, which we will try to talk about in the next couple of slides. If e-invoicing is applicable, necessarily you will have to raise an e-invoice. Otherwise, there is something known as a normal invoice which people have been raising over a period of time. As compared to that, when you're looking at credit note, debit notes, again, if e-invoicing is applicable, even the GST credit notes and debit notes will be in the format of e-invoicing. Otherwise, a normal GST credit note or a GST debit note. Now, for both these credit notes and debit notes, we need to understand that the commercial understanding of a credit note, debit note may be different than a GST credit note, debit note. For example, when you are looking at a credit note, the GST credit note will give a GST impact for reversing the GST already charged in the tax invoice. Whereas a financial credit note will not give a GST impact, and there are various reasons why that has to be done. Section 34 defines what all types of adjustments are permitted through a credit note. Only in those cases you can give a GST credit note. For example, if you have a post supply discount, or you are raising a credit note for a waiver or a bad debt, in that case the GST adjustment is not permitted. In that case, you will be raising a financial credit note, and this confusion is always there, and at times there is also a tendency of SSEs wanting to claim the GST offset and recoloring a financial credit note into a GST credit note. So that has to be avoided. The second aspect is that the credit note has a timeline. It has to, a credit note for an invoice pertaining to a particular year has to be raised by the September of the next financial year. All of us are aware of these timelines. And if you are raising a delayed credit note, that delayed credit note also cannot be a GST credit note. It will have to be a financial credit note. Similarly, for debit notes also, though there is no timeline for a debit note, there is this concept of a GST debit note as well as a financial debit note. Now, on the GST debit note, For the recipient, there has been an amendment in the current budget, last budget, which has been notified in December, which says that you will be able to claim that credit on the debit note on the basis of the debit note rather than the underlying invoice. And therefore, there is a little bit of a relaxation in the timelines for the claim of the credit on an underlying debit note. So these are the documents which are issued for tax transactions. Thereafter, if you are dealing in exempted supplies, you have to raise a bill of supply. If there are taxable advances of services, you will raise a receipt voucher at the time of receipt of advance, and thereafter, through an invoice, you will adjust that receipt. Or if you have to refund the advance, you will raise a refund voucher. Now, while all of this is there, there are also documents which have to be raised, especially for goods when you are transporting or moving the goods. So typically you will be raising a delivery challan. If there's a transporter involved, there will be a consignment note or an LR or a RR or a courier receipt or some document of the third party in that nature. But what is more important is if the value of the consignment is higher than a particular limit, you are required to raise an e-way bill, and that e-way bill has to be generated from the government portal, and that portal will define the time limit of the e-way bill. You have to make sure that the movement is concluded before that time limit. All of these are things which we are aware of, but I thought it's important to really rebrush upon the basics for those who are joining afresh. Now that takes me to the main this first important topic of discussion today, which is e-invoicing. And the whole objective of e-invoicing is to really bring a real-time compliance into the government, into the entire GST compliance regime. It has already been implemented for entities above 100 crores. It started with entities above 500 crores on 1st of October, and then it was expanded to entities above 100 crores from 1st of January. We are told that it will become applicable for entities above 5 crores from 1st of April. And at some point of time, the objective is to really make sure that everyone undergoes this e-invoicing mechanism. Now, there is a fundamental difference between e-invoicing requirements for a B2B transaction and a B2C transaction. All of us over the last 3 years understand this distinction. B2B transaction is a transaction where your customer has a GST number and therefore he might be interested in a credit, and you are passing on the credit by filing your GSTR1 at a transactional level, which goes and reflects in his GSTR2A. As compared to that, in a B2C transaction, the customer does not have a GST number. He either is an end consumer, or he is an exempted business, or he is a small business and therefore he has not obtained a GST number. In those cases, you upload the data on an aggregate basis and there is no GSTR2A where this data flows. And therefore, when you are looking at e-invoicing, there are very different sets of provisions for both of them. Now, primarily B2B e-invoicing is the more important part, where the government wants to ensure that the reconciliation is simplified. The input tax credit, there is a little bit of a certainty on the input tax credit, and therefore the focus of the government has been on B2B e-invoicing. In the conceptually, in B2B, what we are now told is if you are crossing the thresholds which are mentioned in this table, you will, before you raise an invoice on the customer, you will prepare the data for the invoice, send that data to the government portal in a JSON format, and obtain two attributes. One, IRN, invoice reference number, which is a 64-digit cryptic code. The government portal will send it back to you. And there will be a QR code, which is a digital image. You have to put both these things onto the tax invoice, and only thereafter will it be treated as a valid invoice. Otherwise, your document which you are issuing as a tax invoice will be an invalid invoice. So essentially, the moment you raise an invoice, you will be effectively communicating the entire set of data to the government portal. And this is what is being expected as far as a B2B transaction is concerned. For B2C transactions, there is a concept called dynamic QR code, which has become applicable for entities above 500 crores. However, the penalties for that have been waived, and therefore up to 31st of March. And therefore, effectively, right now, there is not too much of activity happening on the B2C dynamic QR code. And for our presentation also, we will try to skip the discussion on that and we'll concentrate on the B2B e-invoicing provisions. I think this is a very important amendment in terms of B2B e-invoicing. And I would just like to highlight the amended process flow, which will come into place because of these e-invoicing provisions. So friends, as of today, Let us take an example that you are raising an invoice, pre-e-invoicing regime. You are raising an invoice on the 5th of January. What happens is you prepare an invoice in your system, in your Tally, in your ERP. You get it printed, you sign it, and then maybe you courier it or email it to the customer. Typically, this might take 5-7 days, and the customer might receive the invoice maybe on the 10th or the 12th of January. His purchase department will take its own time in approving the document and thereafter entering the document in the accounting system. And therefore, there will be a scenario where you have raised an invoice on the 5th of January. The customer accounts it maybe by the end of January. And thereafter, when the month ends, you will file your GSTR1 on the 10th of February. When you file the GSTR1 on the 10th or 11th of February, the information will auto-populate in the GSTR2A of the customer. Now, when the customer who is a purchaser who is claiming input tax credit is expected to reconcile this 2A, which will be reflected in his 2A on the 11th of February with the books of accounts where this transaction will appear in the month of January. And then naturally, based on the invoice number, he will do a lookup and he will match it. And then he will claim the credit. This is how the current process flow works. Now, this has its own sets of challenges in terms of reconciliation, etc. So what e-invoicing does is, it says that when you generate the invoice, you have to send that invoice onto a government portal, which is known as the invoice registration portal. Now, naturally, if there is one or two documents, you can do it through the offline mode. But if you have many documents, you will want an intermediary ASP, GSP, who can help you to do all this. It's a technology software. And through the ASP, GSP linkages, you can push the data onto the invoice registration portal. Now, once the data goes on the invoice registration portal and the 64-digit IRN and the QR code is created, thereafter on the same day or on the next day, the data goes on the GSTN network and there is a real-time update in your GSTR1 as well as in your customer's GSTR2A. So once this system gets streamlined, today it's happening on a T+2 basis, but once this system gets streamlined, maybe in a month or two, what will happen is an invoice which you have generated on 5th of January will be available in your records, in the ASP GST system, on the IRN portal, on the GST network, as well as on the customer's database on the 5th of January itself. Now, this, according to me, while it looks as a very small step, it has a major change in the entire way businesses are being conducted. What it effectively means is there will be no possibility of a backdated transaction or an amendment in an invoice which has been originally issued. And therefore, you have to be very, very careful before raising an invoice, before undertaking a transaction and putting up a document for an IRN generation. While the government portal does allow a 24-hour window for cancellation, according to us, this 24-hour window of cancellation will result in a lot of reconciliations. So once an IRN has been generated, we strongly advise our clients not to make any changes or cancellations to that invoice. If at all business requirements require you to make some changes in that, please use the debit note or the credit note route. Now, that is a major business process change and a mindset change which will be required at each and every stakeholder level because of the e-invoicing. And this will definitely improve a lot of transparency in the bring a lot of transparency in the entire process. So friends, we quickly go into the various types of documents or transactions and the applicability of e-invoicing provisions to them. So as we have discussed, for B2B transactions, you will be required to raise an IRN and a QR code, of course, subject to your turnover being above the threshold, which we had discussed in the earlier table. Now, please note that it's applicable to all types of B2B invoices. It is not only your normal sales. You can have other income invoices, you can have a fixed asset sale, you can have a scrap sale. All those transactions will be required to be bearing an IRN and a QR code, and you will have to raise those documents accordingly. You also have to consider the fact that even interstate branch transfers, if you are a multi-locational entity, even interstate branch transfer invoices will be going through this IRN QR code routine. The B2B debit notes and credit notes would also go through the IRN QR code routine. For your exports, now this is an important aspect because at some point of time when you are going to file refund claims for your exports, it's important that there is a matching of this IRN QR code. So for all your export invoices, your IRN QR code is mandatory. Let it be an export of goods or let it be an export of services. For B2G transactions, where the government entity is registered either for GST or for GST TDS, you are required to create an IRN QR code. Where the B2G entity is neither registered for GST nor for TDS, then the question of IRN QR code does not arise. As far as B2C is concerned, we've discussed that there's a dynamic QR code applicable for entities above 500 crores only, and that too has been kept in abeyance as of now, so we can just skip it for the time being. For exempted supplies, where you are raising a bill of supply, there IRN QR code is not applicable. And that's also one important aspect which we need to bear in mind now, that if you have one document where there are some taxable activities and some exempted activities, you will be required to raise two separate documents, one tax invoice for the taxable transactions and one bill of supply for the exempted transactions. That takes me to the outward RCM, where you are, let's say, a transporter yourself and you are registered. In 95% of the cases, you are having examples where RCM is applicable. So in those cases where you are raising an invoice where you are not required to pay the tax, but the recipient will pay the tax, in those cases of outward RCM, IRN QR code is applicable. But on your expenses where there's an inward RCM and you are raising your self invoice, there an IRN QR code is not applicable. So these are the various scenarios which one needs to bear in mind as far as e-invoicing is concerned, and the applicability of e-invoicing on those various scenarios. This is one more slide where we will revisit some legislative and judicial developments on certain areas of open-ended questions which were there. I'm aware that many of our clients, we've given the positions on each of them, but based on the materiality and the risk appetite, each client might have taken different positions in terms of implementation, and therefore we felt that maybe we should rebrush those aspects for a minute or two and then move into the next aspect of discussion. So on the outward supplies, there has always been a controversy on whether recoveries which are made from employees, which are in the nature of reduction of expenses, maybe it's a notice period recovery, or if the company is providing bus transport at a subsidized rate or a canteen provision at a subsidized rate. Sometimes company undertakes a group mediclaim and recovers a part of the insurance premium from the employees, etc. All these cases, whether there is a GST applicable when the company recovers some amount from the payroll. Now, of course, in the initial stages, there were a couple of advance rulings which suggested that GST is applicable, especially in canteen recoveries and things like that. However, on first principles, one would say that it's really the employee who is rendering an employment service to the company and not the company rendering any service to the employee. So therefore, just because there is some recovery from the employee, it actually is a reduction in my expenditure and not really a service rendered by me. And this is a type of a position which somewhere is highlighted by a couple of high court rulings in the recent past, and also one more recent advance ruling wherein it has been held that mediclaim recovery is not liable for payment of GST in the hands of the company. So depending on the risk appetite, the company might want to take a position. In certain cases, the company would like to take a conservative view, especially considering the fact that if we take a conservative view, we might be perhaps eligible for the input tax credit, because as you know, otherwise tax credit is barred for all expenses relating to employees. But if you are having a pass-through type of a mechanism, then maybe you claim corresponding input tax credit and recover it from the employees, and that reduces the exposure or the risk. So accordingly, companies have taken different types of positions. As far as group company recoveries is concerned, it might be in the nature of cost sharing, it might be in the nature of apportionment of common overheads, or certain common infrastructure shared by all the companies within the group. Now here one will have to trade it a little bit cautiously, because there are multiple entities involved, and there is an entry under the GST law which talks about agreeing to do or tolerate an act. And therefore, a view can be taken that your ability to give an infrastructure is in itself a rendition of a service, and therefore there should be an exposure to GST. I'm aware that in the service tax regime, there are quite a few decisions which say that these do not constitute a service. But considering the fact that under the GST law, there are credits generally available, we have generally advised a very conservative view on this. We are suggesting that there has to be a GST on this. The company who is recovering the amounts will charge GST, and the other company will claim the credit. And that is, I think, a risk-free and a litigation averse position which one should ideally take. The next one is interesting, and here again there are a couple of High Court rulings which say that liquidated damages and penalties do not constitute a consideration for rendering a service, and therefore there should not be a GST. This typically arises in case of contracts where you are given a contract for construction, and then there's a delay by the contractor, and therefore you deduct certain amounts from his contractual payments. And those types of damages or penalties, they essentially do not entail any rendition of a service, and therefore there's no question of paying any GST on those types of transactions. Again, coming back to reimbursement claims, the whole objective again is to ensure a free flow of credit, and the only way one can ensure a free flow of credit is to ignore this concept of reimbursement, charge tax on the output side, and claim the corresponding input tax credit. Any other position will somewhere disrupt the entire input tax credit chain, and therefore will be more cost prohibitive as well as risky proposition. We've talked about interstate branch transfers at length at various forums, and we've tried to implement it in many cases. But yes, this is one area which is a pain. We are aware of the concepts of branch transfer of goods, which is not only of raw materials and finished goods, but also branch transfer of assets. When we undertook GST audits, we found that there have been scenarios where there have been asset movements from one state to another, but organizations may have by error missed out on raising a branch transfer invoice. So this is one area where some improvement might be required on these types of transactions. Of course, because of a proviso to Rule 28, where the client is eligible for full input tax credit, essentially the government also has said that valuation will not be questioned. So therefore, our strong advice would be to really implement a proper branch transfer policy. Valuation is subjective depending on the credit accumulation, depending on the organization profile. One can choose an appropriate valuation mechanism, but definitely one should go ahead with instating a proper branch transfer policy which comprehensively covers movement of goods, movement of assets, as well as the provision of services, both specific services as well as indirect services in terms of corporate overheads and the various expenses which are in support services given by the head office to the branches or the branches to the head office. So that is something. If in any case you all have not done it, we'll request you to reach out to your relationship manager or to me, and we can discuss it out and let's implement it so that we do not have any open positions in the future. And this is one more area where we keep on getting many questions and queries on a day-to-day basis, and I thought that this is important to discuss, is relating to the eligibility of discounts. In the first slide, we did talk about the GST credit note and said that the GST credit note is available. A discount is eligible as a reduction only if certain conditions are satisfied. And the first condition is that the waiver or the discount should be a part of the agreement which has been signed in or entered into prior to the supply itself, before the sale is made. You are required to issue a credit note before the September of the next financial year. Typically, the expectation is that the invoice or the credit note for the discount will be linked with the invoice. Of course, this condition in the law has been relaxed, and even the portal permits an credit note without an invoice now. However, one would still, because of the requirement of a financial year driven matching, one will still have to somewhere link it with the financial year for which the transaction is applicable. And finally, and this is a very important onerous condition, if you are claiming a reduction in your output tax on account of discount, it is also important that the buyer reverses the corresponding input tax credit. Now, this is something which at times is very onerous and difficult to comply. And therefore, many organizations end up saying that, look, I have anyways collected and paid the tax. The customer has claimed the credit. So why should I in the credit note even look at GST component? And many organizations have tried to do a commercial credit note. So what they do is, for the discount, they do not raise a credit note with the GST component. They raise a credit note without a GST component. In fact, there has been a circular which says that this is perfectly fine. The supplier may not claim a reduction in the output tax, and the buyer need not reverse the input tax credit. So long as both of them are eligible for input tax credit and there is a reasonable value addition, this can work. But in certain industries, the value addition is so low that the buyer, if he does not reverse the input tax credit, he will end up with an ITC blockage. And in these types of scenarios, in many cases, OEMs insist that rather than doing a credit note and keeping these many open-ended issues, you raise a marketing invoice or a incentive invoice. And therefore, there in those types of scenarios, you end up with a reverse supply. Now, similar scenario happens in goods also. For example, in the pharma sector, when there is a reverse movement and goods rejected by the retailer to the distributor and the distributor to the pharma company, many a times there's a suggestion in the industry that a reverse invoice be issued rather than a credit note being issued. Now, of course, there is a circular which also permits this type of a treatment, but one will have to be careful that the transaction, the documentation as well as the accounting should be similar, because what happens is in accounting you would treat it as a purchase return, and in GST you will treat it as a sales, and then you will end up with various types of reconciliations. So all those aspects can be avoided and queries can be avoided if there is a synchronization and an alignment between the GST document and the accounting treatment of the transaction. That takes me to the sale of fixed assets. And on the sale of fixed assets, one important priority which they have done is the motor cars. So for motor cars, there is a margin scheme, because typically they do not give you credit. As you are aware, under the excise and the VAT regime, there was no credit available for motor cars, and the same provision continues in the GST as well. And therefore, when you sell, if you have to again pay tax on the full value, it becomes an undue burden on you. Therefore, the government has, through a notification, defined a margin scheme for motor cars where credit is not claimed at the time of purchase. So effectively what you do is you pay the tax on the difference between the sale price and the WDV as per the Income Tax Act. And if there is a margin, in many cases our practical experience is this ends up in a loss which has to be ignored. But if there is a profit and there is a margin, you have to end up paying a reduced tax rate, because typically motor cars have varied tax rates, all the way from 28% plus cesses. But here you are given a reduced tax rate for used motor cars of 12 or 18%, depending on the type of the motor vehicle. And in all cases, compensation cess has been exempted. Please note, all of this applies only for sale of used cars where credit has not been claimed at the time of purchase. There was one more entry which gave a further reduction by 35% for old cars which were bought in the pre-GST regime. Please note that has been discontinued with effect from 1st of July 2020. And therefore, even if today you are selling a car which was bought before 2017, you will apply the margin scheme and pay the 12 or 18%. You will not get the further reduction of 35% in those cases. So that is a change which has happened after we last met and discussed this aspect. For other fixed assets, you have to pay tax on the sale price. There's no margin scheme over there. And if you have purchased after 1st of July 2017, you have to consider section 18(6), which requires that either your sale price should be equivalent to the depreciated value, and if you are selling at a value lower than the depreciated value, then you have to reverse the ITC on the difference. And for this purpose, the depreciation is calculated by using a formula of 5% per quarter of consumption, which means that 20% per annum on a straight line basis. Now, this is something which has to be importantly understood. Again, just like you talked about sale of fixed assets, if there is a fixed asset which is used in one premises for 2 years and thereafter transferred as a stock transfer to another branch, in that case also this type of provisions will get implemented, and one will have to make sure that we are implementing this in the correct manner. That takes me to zero rating. And one important thing, as we discussed earlier, zero rating is export of goods or services or supplies to SEZ. And there is a concept of letter of undertaking. Most of the exporters know about it, and it has to be renewed every year. I'm sure most of us have renewed it for the financial year 2021. But by any chance, if someone has not renewed it, please renew it right away, so that at least we can claim the benefit of an old circular and defend the non-payment of tax for the 6-7 months or 8 months which have already passed. For 21-22 also, the window is open already. So I would suggest that you obtain a renewal well in advance so that you don't have to worry about your exports getting stuck or your benefit of LUT not being available to you. So one can always renew a little bit in advance rather than wait for the last day of 30th of 31st of March. Now, as far as SEZ supplies are concerned, there has always been that debate of whether the place of supply rules will override the SEZ provisions. And the answer to that is clearly no. It's the SEZ provisions which will override the place of supply rules. And therefore, so long as you deal with an SEZ, the transaction will always be an IGST. And we, in the last session also, we took an example of a supplies made by a hotel to an SEZ unit would be zero rated because of the IGST concept and the provisions of the IGST law. At the same time, there are various documentation requirements, and nowadays we are finding that there's a lot of insistence that the supplies which are rendered by the domestic unit to the SEZ unit should be demonstrated to be used for the authorized operations of the SEZ. And that applicability comes ideally only in the case where a refund claim is being filed by the domestic supplier, but there are varying interpretations on this ground, and therefore it might be important for a domestic supplier to obtain a declaration from the SEZ supplier and appropriate documentation to ensure that the supplies are used for the purposes of authorized operations within the SEZ area. Now comes the exports, and as far as export of services are concerned, all of us are aware of the multiple conditions which are there. Two of the important conditions being the place of supply being outside India and the receipt of money in convertible foreign exchange. In fact, now the government says that if the convertible foreign exchange is not realized within the prescribed time limits, the refunds which have been granted will be recovered, and that applies to both export of services as well as export of goods. There is a timeline within which you have to obtain the convertible foreign exchange, or you have to seek an extension. If that has not happened, then the refunds which you have already claimed have to be reverted back to the government at that point of time. There is a one anti-avoidance provision which came in last year, which was a condition that your export price should be less than 150% of the domestic price of similar goods in case of sale in domestic market. And this is ideally to avoid scenarios where people inflate export billing in so that they get higher incentives and they can avoid some amount of indirect taxes on that front. So this is, of course, my understanding is that there would be hardly any example where somebody would inflate, because at the end of the day there's no income tax benefit as of today. So there's no reason why somebody should do this. But yes, this condition has been brought in, so we have to be careful about this condition if we are indulging in some element of over invoicing for export transactions. So this I thought was relevant from the perspective of output side. Now we go to the major part of our discussion, which is the input tax credit. And this is an area where I feel there is the entire good and simple tax has become really not simple, but a sort of a Gabbar Singh tax. And lots of challenges on this front. And those challenges, let's understand from firstly from the trade perspective, because all the participants today are representing industry and trade. And all of us understand the concept of input tax credit, that a creditable input tax credit is not an asset and therefore is not taken into account in costing while determining the sale price or while deciding the profits. All of us are aware that you might purchase products at 100 plus 18, you'll sell it at 100 plus 19.8, and in that case the differential GST of 19 minus 18, 1.8 will be paid to the government, and you will expect an input tax credit of 18. If that input tax credit of 18 is given to you, you will end up earning a profit of 10. And this is the assumption on the basis of which a businessman would do a business. Now, at a later point of time, the businessman is told for various reasons, and we'll discuss all those reasons in detail, that I am not going to give you this input tax credit of 18. Now, the moment the government says that I'm not going to give you this 18, what happens is, for the businessman, the cost price increases to 118. He already sold the goods at 110 on the assumption that he will get an input tax credit, and therefore he will now end up with a loss of 8 rupees. So a profit position straight away ends up in a loss position. And we've seen examples where, because of subsequent action by the department and denial of input tax credit, the department starts demanding money in terms of input tax credit reversals, but the entity does not have any funds to pay the tax because the business was done at so small margins. Today 18% GST rate is the general GST rate. the gross margins may be much lesser than that. I am aware of businesses which work on wafer thin margins like 1 or 2%. And that is where I think the fundamental challenge for the trade arises. The trade expects a certainty of credit on the day of the transaction. It doesn't want to go into the zone of saying, what if the vendor does not subsequently file the return? What if his invoice turns out to be a fake? What if his registration is cancelled? These are the uncertainties which are there in the mind of the businessman or the trader. At the same time, when you're looking at the government finds that there are various examples where people have misused the provisions. There is a then these words are very standard words, not only in India, across the globe. You will find that there have been examples of these types of frauds. There's a concept called a missing dealer fraud. A person will raise an invoice. He has supplied the goods. He raises the invoice. He collects 118 rupees. He has to pay the tax by the 20th of the next month. But before the 20th of the next month, he diverts this money to either pay for his own household expenses or to fund some of his other costs. Now, in these type of scenarios, he does not pay his tax. He does not file his GSTR 3B or GSTR 1. And therefore, the government doesn't get the money. If the government doesn't get the money, the government says, I cannot give you back the credit. Now, this is the missing dealer fraud which happens. And more importantly, there are examples of bogus frauds where a person will raise an invoice, upload it, show it in the returns, pay the taxes, but at the same time, he will not supply the goods. In those types of scenarios, there's clearly a case where the government is at a loss of revenue. Now, this could be various examples in which this can happen. And a very common example is a substitution fraud, where what would happen is assuming A is some product, is in some product which can be sold in retail as well as in businesses, something like a mobile. So he might sell a mobile to X without an invoice. He might have charged GST on it, and means because he is negotiating only on the basis of MRP, he gives a small concession to X and he sells it. Now, naturally, because he has bought it on payment of taxes, it is showing in his books of accounts as a stock. Now, what he will do is he has a stock in books, but he physically does not have any stock. So he raises an invoice on Y, and he does not supply goods to Y, but just adjusts the transaction. Now, in this scenario, the government's collection falls down, because what happens is, ideally, this product is consumed by X, which is a B2C transaction, and the government would have got a tax. But instead of that, Y, who has not bought the goods, is claiming the credit. And therefore, there is a loss of revenue in case of fake invoicing. And these are the types of challenges which the government faces. And in this ocean of transactions, at times they find it very difficult to find all these scenarios and to address these scenarios. And therefore, we see that there have been various provisions which the government wants to introduce to make sure that these types of frauds do not happen. So let's look at it from a timeline journey. And when the GST law was implemented, the government introduced section 16(2) to specify some conditions for claim of credit. And the government thought that perhaps these conditions, along with the GSTN portal, the ambitious project which they had of line-to-line matching, the government felt that this would have been foolproof mechanism to ensure that these frauds do not occur. So therefore, in 16(2) we were told that you can claim the credit only if you have received the goods or services. This condition essentially is to tackle the issue of fake invoicing. You have received an invoice, you have paid it, it appears in your 2A, but if you have not received the goods or services, necessarily you are a party to this third fraud, which is the substitution fraud. And therefore, right from day one, the law on this is very clear that unless you have received the goods or services, you cannot claim the input tax credit. Of course, the goods or services should be used for business. You should have received the invoice, and the vendor should have paid the tax, because if he has not paid the tax, you can't claim the credit. Further, we are told that you should make the payment to the vendor within 180 days. Now, this ideally is also to make sure and track scenarios where people raise invoices for the purposes of adjustment, and then typically just don't settle the accounts. So therefore, there is a condition that the payment has to be made to the vendor within 180 days. Now, finally, the government also felt it appropriate that we should define some timelines for claim of credit, so that people do not keep positions open-ended. And therefore we are told that for any financial year you have to claim the credit by the September of the next financial year. We are aware that when we do the audits, we find many examples where people have missed out on some genuine credits, and then we show it in your GSTR 9 as credit which has been lapsed. So what are those timelines? We are all aware 17-18 there was a special extension whereby the timeline was 20th of April 2019, but thereafter it's the due date of filing the return for the month of September, which falls on the 20th of October. So effectively, if you look at it today, if you receive an invoice of financial year 1920 on which the vendor has charged you GST, today you cannot claim the credit. And day in and day out, we receive queries on this regard that how to salvage this credit, and this is really impossible to salvage the credit, and the credit is essentially lost. So it's like you have missed the bus, and if you have missed the bus, nothing can be done on it. And of course, it covers various types of scenarios like say, cases of forward charge as well as reverse charge. But for import of goods where a bill of entry is filed, it is not applicable. And more importantly, it is not applicable if you are claiming the credit for the second time. As you are aware, there are various scenarios where you will claim the credit. Thereafter, because of certain reasons, you are required to reverse the credit, and then you can reclaim the credit. So for example, if you have received an invoice today, you can claim the credit. If you don't make the payment within 180 days, you have to reverse the credit. And thereafter, we are told when you make the payment, you can reclaim the credit or claim a recredit of the already reversed credit. Now we are told that in case of this recredit of already reversed credit, the time limit is not applicable. And therefore, to overcome this issue of 16.4, one can at times look at this position that is it possible that in the month of September, we claim all open-ended credits and reverse the credit on the same day, and then reclaim the credits as and when the payments are made. In that case, perhaps we can keep a little bit of a life open for the credits which are likely to get expired. So this is the next aspect which the government is grappling with. How does the government ensure that the vendor has paid the correct tax? And this is where they found it very, very difficult. Initially, their ambitious project was the GSTR 1, 2A, 2, 1, 3. All of us are aware of this 5-step return filing process, which never saw the light of the day. When the first month return had to be filed, the portal crashed. There was a lot of furor, and there were elections around the corner. And therefore, instead of 3, we brought in a simple return called 3B. So what ultimately got implemented was GSTR 1, 2A, and 3B. Now, as we are all aware, 3B is just a total document, and therefore there was no mechanism to match what is there in 2A and whether those credits are correctly claimed in 3B or not. So in middle, somewhere in October 2019, we brought in a rule called Rule 36.4, wherein we said the SSE will in Excel or in his own backend records will compare 2A and the credit as per books of accounts. And if there are mismatched credits, there is a tolerance limit which has been specified. In October 19, we specified 20%, then we reduced it to 10%. And in the recent amendment, we are further reducing it to 5% effective from 1st of January 2021. So effectively, that is where we try to bring about a less element of mismatch in the industry, and therefore the government is assured that the taxes are paid in the right manner. And while all of this is happening, perhaps the government still feels insecure, and therefore they have brought in this concept of e-invoicing. As we talked about e-invoicing in a few slides earlier, e-invoicing will ensure that there's a real-time reconciliation which will happen, and there is this e-way bill which will also get auto-populated from an e-invoice. So effectively, in the next couple of months, we are seeing that there is going to be a new workflow which will emerge, which is e-invoice being created, which getting auto-populated into an e-way bill with only the transport details being filled separately, automatically coming into your GSTR 1, going into the customer's GSTR 2A, and then flowing into an aggregate level into GSTR 2B. Now, what is this GSTR 2B? This is an interim form which has been brought in, which summarizes the data in GSTR 2A as on a particular date. So GSTR 2A is more like a dynamic document, whereas GSTR 2B is static as on a particular date. And then we are told that the credit as per GSTR 2B and the GSTR 3B can be compared, and the tolerance limit can be established. And now we also have further rules to ensure that people comply with the provisions of Rule 36.4. So matching, mismatching, reconciliation. I know all of us have spent countless hours on this aspect, but just to summarize the entire thought process, 36.4 was introduced in October 2019. In our view, prior to October 2019, while we might, as a best practice, do this reconciliation and matching, there is no legal requirement to reverse the credit for unmatched transactions. In our view, there is no such requirement because there is neither a legal basis nor a logical basis to do this. In fact, the government issued a press release in September 2018, where also a similar view has been taken. Delhi High Court has also taken a similar view in Bharti Telemedia's case. When we come to documents, GSTR 9C stays away from GSTR 2A reconciliation. GSTR 9 somewhere brings 2A versus books reconciliation, but it only says that if the difference is positive, it will lapse. It doesn't say that if the difference is negative, you have to reverse the credit. In fact, a clinching aspect is that the department GST audit manual has a very specific situation wherein the department officers are are informed about a scenario where there is a mismatch between GSTR 2A and the books. And there they are suggested an action that you please go to the supplier and verify whether they have paid the tax. If they have paid the tax, allow it. If they have not paid the tax, then corrective action can be taken. So the point which we are trying to stress is prior to 2019, there is no legal requirement for any reversal whatsoever. And all these points will become very important because the GST audits are just around the corner. They have started. When I say GST audit, I mean the department audit. I am aware many of our SSAs have received these notices and initial preliminary data is being exchanged. So when these queries will come from the department audit teams, this will be an important defense point which we will have to raise depending on the materiality of the amounts involved. But with 36.4 coming into place, all this discussion changes. It becomes academic. And from 9th of October 2019, when Rule 36.4 comes, we are told that the ITC to be availed by registered persons in respect of invoices which are mismatched, which means not uploaded by the suppliers, shall not exceed a particular percentage of eligible credit of matched transactions. Please note, it's only the eligible credit of matched transactions, and you take a particular percentage of it. Only up to that level the tolerance limit is allowed. Now, what is that percentage? We are all aware up to December 19 it was 20%. Thereafter they reduced it to 10%. With the COVID situation, for the months from March to August, there was no restriction, and they had relaxed this condition, saying that you will apply it cumulatively in September. From September to December, therefore, you have a 10% limit, and now it is proposed that this 10% will be reduced to 5%. I am aware that many organizations don't even go into this entire zone. They straight away say that we'll claim the credit on the basis of matched credit only. How to keep a track of this 5% and all is going to be very, very complicated. And these are the aspects which typically come as a puzzle point in most of the organizations. The first aspect which comes is there are commercial considerations. You do not want to pay to the vendor and not claim the credit, because then effectively you are incurring a loss. We discussed that in the first slide of input tax credit. There is a TDS applicable, so you have to consider the provisions of TDS as well. Many organizations want to not make the payment to the vendor till the time he has uploaded the credit. But there is an MSME Act which says that you have to make the payment to the vendor within the stipulated timelines. There's also this provision which says that you have to make the payment to the vendor within 180 days, otherwise you can't claim the credit. You have this 36.4 which talks about the 5% restriction now. You also have a requirement to account for all the invoices of a particular year within that year. And more importantly, you have a time limit under 16.4. When you look at so many parameters, the challenge which comes is how do you make sure that you balance all of these and safeguard your input tax credit also. And that's where I think the best case scenario, and of course this is at times I am aware that some organizations have done it, but it may be difficult for many, but this is the best case scenario. And then in individual cases, one may like to look at how things might change. In a best case scenario, the way things are today, how one should look at it is like this. Step one, whenever the vendor raises an invoice on you, there will be a base value, there will be a tax. Pass separate entries to account for the expense and separate entry to account for the credit, which goes in a parking account, not into the ITC credit account. As far as the expense is concerned, pay the amount to the vendor in your normal course with applicable TDS. Hold back the credit amount, and it can be a part of your purchase order. If it is a part of the purchase order, I believe it would be an MSME compliant withholding of the money. Wait for the vendor to upload the tax in your 2A in his GSTR1 and coming in your 2A. Undertake the 2A matching. Once that 2A matching happens, move the credit from the parking account into your credit account and claim the credit. Once you have claimed this match credit, pay that match credit to the vendor. Therefore, in this type of a process, if the vendor doesn't pay, you are not at a loss, because you have not paid him until he has paid to the government and uploaded in your 2A. Now, when you do this, periodically you will have to review your parking account and also the open entries in 2A. And you might find that there might be some invoice number mismatches or GSTN mismatches, and take corrective actions, contra entries wherever required. And thereafter, when the September of the next year comes, you will have to decide what do you want to do for the parking account. Now, in the September, when you have a parking account and a balance within that, what it means is the vendor raised an invoice in the month of, let's say, March 20, and you have paid him the basic value. You have still not paid him the tax component because he has not uploaded it. Now comes September, you have to decide, because September is the last moment when you can claim the credit. Now he has not paid, and because he has not paid, you are not claiming the credit because of the mismatch issue. If September passes by, then that mismatch is forever. You cannot never claim it. So whether you will always retain the money from the vendor, or there's another option to claim and reverse, again subject to the 5% tolerance limit. Now this is a decision which an organization will have to take in consultation with the vendors and with the business teams. Same way, there can be scenarios where the vendors have uploaded taxes in your account in your GSTR2A, but the transaction has not flown into your books of accounts. And that's where one can consider whether one wants to claim and reverse the credit, so as to keep the possibility of recredit open at that point of time. Now, of course, I'm aware this is the best case scenario. Things can get fairly complicated in cases where there is also an expense of ratio in the form of Rule 42, because then again you have to look at how are you going to deal with that aspect of proportionate reversal also. But well, that's how life is. But this is one set of the frauds which we are talking about and the government was grappling with, which is relating to a scenario where a person collects the tax and tries to make money out of the tax. The second scenario is a scenario where there is a substitution or a bogus invoice, a scenario where there's an invoice, maybe the objective is not GST non-compliance, and therefore the person would actually go ahead and upload it in the GSTR1 2A, but there is no underlying product. And this is what we say is a fake invoicing. Even today, if you must have read the newspapers, there have been detailed investigations and raids being conducted on some reputed business groups on the account of these bogus invoices. Various business dynamics also require entities to indulge into these types of activities. And yeah, so this is a problem which does exist. And to address that issue, we have amended sections 122 and 132 to not only cover the person who issues a fake invoice, but also the person who is benefiting out of that fake invoice. So it's not only the supplier, but also the so-called recipient who gets covered. And this is very important. Most of the organizations, to just save on income tax or generate some on money from the business, they book expenses in the books which are bogus. Now that is what is also being tracked through this mechanism of fake invoicing, and they become beneficiaries of fake invoicing, and they are also liable for penalties and prosecution. Last year, the government also brought in Rule 86A, where if a commissioner has a suspicion of fake invoicing, he can artificially block the input tax credit balance lying in your account. And then he might say that I will release it only when I have satisfactorily completed and made sure that your products are correctly bought by you and it's not just a fake invoice. More importantly, recently we have brought in a Rule 86B, which requires entities, because again this is a presumption which the government had, that those who are indulging in fake invoicing will pay most of the taxes through credits and create a chain of entities A to B, B to C, C to D, etc. So they are saying that you cannot pay 100% tax in cash. You have to in credit. You have to pay at least 1% of your output tax in cash. Now, this might have impacted many, but there are lots of exceptions to this rule, and rightly so. Therefore, I would believe that most of the genuine scenarios may not get covered. What are those exceptions? If the entity has paid at least 1 lakh of tax in the last 3 years, income tax in the last 3 years, or any of its directors has paid 1 lakh of income tax in the last 3 years, then this rule is not applicable. Similarly, this rule is not applicable if your turnover is less than 50 lakhs per month. Thirdly, if you are claimed or you have received any refund for exports or inverted duty structure, then this rule 86B is not applicable. I would believe that most of the scenarios, most of the entities would fit within these scenarios. You may like to look at it. If you are not fitting within that or you have some doubts, please reach out to us and we can look at your specific example. It's a rule which is a funny rule, I would say, but not really impacting too much, and therefore one can keep on criticizing, but it's more, according to me, a theoretical rule rather than something which impacts the masses or a large number of people. When you are looking at fake invoicing, please also note that there are penal provisions under the Income Tax Act as well. And while there is no sympathy against the genuine fake invoicing entities, what is feared is a scenario where the department officers might unnecessarily try to harass people or argue that there are transactions of fake invoicing, because all of this happens as a post-mortem, and as a post-mortem, sometimes it becomes very difficult to establish whether you had maybe 1 year ago received the goods or services, or you had not received the goods or services. And that's where this $1 million question comes in, that how are you going to defend fake invoicing allegations? And I think there are some important areas which one will have to be careful about. Our experience is that typically their investigation and the data analytics which is being done by the department is fairly good, and most of the cases where the department is alleging fake invoicing, we have found that actually there has been a fake invoicing. But if you become a sort of a victim of this entire scenario, you have a genuine transaction but it is alleged as a fake invoice, how will you substantiate your transaction? So I think these are some pointers, and each case you will have to, looking at your transaction, build up a corroborative piece of evidence to suggest that this is not fake invoicing. But I think few things which you need to bear in mind is the first bullet point. And if you look at this bullet point, I'm sure that in all fake invoicing cases, this bullet point is fully satisfied. Tax invoice being raised, the payment being made by an account paycheck, uploading on the portal by the vendor, entry in the books of accounts of the vendor and the customer. There is invariably always an LR. There is invariably always a proper e-way bill in these cases. The department has matured beyond it. So this much of documentation will not help you in many cases. What might further be required is to corroborate that there was actually some product. And how do you corroborate it? Maybe you might maintain FASTag records, because today most of the product FASTag is mandatory. So you might have FASTag bills, which will actually demonstrate the movement of the vehicle on the route. If there is an intermediary warehousing, or at your end there is a warehousing, then the records of the stocks and maybe even CCTV records which suggest that there was a loading unloading of goods, corresponding usage in manufacturing, further sale if it's a trading transaction, regularity of transaction with that entity, materiality of the values as compared to the overall transaction, repetitive nature of the transaction. All these aspects will become very, very important in your defenses, and it not being there will result in weaknesses. What is also important is what is the level of pre-transactional correspondence and the documentation. Now, these are some aspects which will have to be taken into account before one can really say that there is a fake invoice or one is going to defend a fake invoice. That takes me to the next aspect, and again, these are some changes which the government has tried to do with an eye to actually track the fake invoicing. And this is where we always believe that a small section of aberrant population will create complications for the 99% of the honest population. But well, be as it may, we are seeing some changes in the registrations processes. In fact, we are told that moving forward, when you are going to obtain a registration, we want to make sure that we are not dealing with SSEs who are going to run away. And therefore, two things are coming into place. One is there will be an other biometric based other authentication of the applicant with a photograph and his thumb impression and etc. And there will also be a physical verification of a place of business of at which the registration is obtained. Now these are two additional checkpoints which are being sought to be brought in at the time of obtaining a fresh registration. Of course, for people who already have registration or even for the new registrations, if at any point of time there is some suspicion, there is a process of suspension of registration or cancellation of registration. Now what is the difference between suspension and cancellation? Suspension is an intermediary process, cancellation is the final process. So till the time investigation is going around, they might want to suspend your registration so that you do not issue a tax invoice or you do not claim refunds. And once the things get finalized, they will cancel your registration. Of course, both are different things. And importantly, we are told registration can be suspended without a show cause notice, without even giving an opportunity of being heard. And now these suspension provisions have two additional points in it, and these are very important. We are told that if there is a significant difference in the output tax or between GSTR 1 and 3B, that could result in suspension of registration. Now, this was some myopic thinking which some people did. They raised invoices and uploaded it in GSTR 1 so that the customers can claim the credit. So, some person will raise invoices of 1 crore rupees, show it in GSTR 1. But when on 20th he has to file 3B, he will pay a tax only on 10 lakhs and not on 1 crore. Now, these types of myopic, short-sightedness, naturally this was going to be caught. But now they found examples like this, and therefore two things they have done. First thing they are doing is, when you file a 3B, there's an auto-population of the totals of GSTR 1. And of course, they allow you to change it, but there's an auto-population right now. And now we are told that if the government finds that there's a significant difference, they will suspend your number also. So even in genuine cases, we have to be careful that we do not make errors while filing GSTR 1 or 3B. I am aware in the initial stage there have been a few errors and there are rectification effects of those errors coming in the subsequent months. But as time progresses now, I think this return filing process will have to be much more stringent, and we will have to make sure that we reduce the errors so that we unnecessarily do not become victims of these types of situations. Again, if there's a significant difference between GSTR 2B and 3B, we saw in the earlier slides 36.4 says only 5% tolerance limit. And if they see that there's a fundamental difference between 2B and 3B beyond that 5%, then also they can suspend the registration because they would feel that this is again something which appears to be suspicious. In various cases, they can cancel a registration. And for cancellation, we are told that a show cause notice is a must. But please note, this show cause notice will be uploaded on the government portal, in your GST portal. Now, what many a times happens is there is a separate section on the portal where these show cause notices are kept. And while the government does send an auto email, if the authorized signatory has changed or if he is busy and he has a deluge of emails, he might miss that email. And therefore, as a tax manager, one would make sure that on a regular basis one looks at the portal and checks whether there is any show cause notice which has been uploaded on the portal, because there are strict timelines for replying to those show cause notices, and in the absence of those responses, then your registration can get cancelled, and that could be a huge challenge if your registration gets cancelled. Now, scenarios where registration can get cancelled is where there is an anti-profiteering action against you. If you have not conducted business for a substantial period of time, you have not provided your bank details, you have issued a fake invoice, you have not filed returns for consecutive periods of 6 months. All of these were already there. But in recent times, 3 more bullet points have been added. If you claim input tax credit in violation of section 16, so again, you go back to your 36.4. 36.4 is issued under section 16. And therefore, if you claim credit of mismatch beyond 5%, there could be a challenge. Again, fake invoicing can be a challenge because you have not received the goods or services. But if it's just an interpretation issue of whether credit is eligible or whether it's a block credit, I would believe that is not a subject matter of cancellation. At the most, it can be a show cause notice. If you file GSTR 1 and disclose turnover greater than 3B, Now that also can be a subject matter of cancellation. It can be a subject matter of suspension as well as a cancellation. And if you violate the recently introduced 86B rule, which talks about 1% cash payment, then also there can be a cancellation. So these are scenarios where the government is now trying to tighten the screws and make sure that there is as less revenue leakage as possible. On the returns front, a QRMP scheme has been introduced. QRMP stands for Quarterly Returns Monthly Payment Scheme. You keep on paying taxes monthly, but you file your returns quarterly. This is for small taxpayers having turnover less than 5 crores. But honestly, we are not recommending this scheme for anyone because there are two things which need to be done. We still have to pay taxes on a monthly basis, on a provisional basis, based on the last period's tax payment. You have to keep on paying the tax for the current period. And also, many of the customers will want the credit to appear in their 2A. Remember 36(4). So the government has brought in an invoice furnishing facility whereby you can upload your invoices on a monthly basis if you want to. Now, essentially, if both those things have to be done on a monthly basis, then the entire QRMP scheme has no relevance. And we are not at all recommending this scheme to anyone. We are saying just go by the normal mechanism, because unnecessarily bringing in a new concept and a new compliance does not make sense. What is also happening is government has now brought in an automatic blocking process on the portal itself. So we are told that if you are not filed GSTR 3B for 2 months or two periods, in that scenario, your facility to file GSTR 1 will be blocked and your facility to issue an e-way bill will be blocked. And essentially, both of these would mean that your businesses get disrupted. And therefore, it is very important now that the returns are filed in time. Now it's a chicken and egg situation, because if you have to file a return, you need to pay the tax. And many a times you might have raised invoices, but you're not received money from the customers, so you do not have the tax to pay it. Now these are the challenges which are there under the new regime, and one will have to really find the solutions and maybe at times look at some working capital arrangements from banks to make sure that you can end up paying the GST in time. That takes us to the next compliance. We just completed one compliance for 1819 GST audit, which was due on 31st December. But till the last moment, we were expecting an extension, but luckily, unluckily, it didn't happen. So 1819 is now history. And for 1920, we are told that the due date is 20th of February 2021. Friends, of late, our experience is that the government is not keen or not sensitized to extensions. Firstly, if at all extensions come, they come on the last day and they come with some strings attached. And at times they come for a very minuscule period of time. So therefore, I would believe that this 20th February 2021 is a date which is sort of a final date, and we should not remain complacent that it will get extended. Corona, no corona, government is less sensitive to these aspects as of now. Which therefore means that we have very limited time window to complete the GST audit for financial year 1920. We also need to consider the fact that right now many of the organizations would also be busy in filing their income tax returns or finalizing their balance sheets. Uh, and in that scenario, whether to prioritize GST audit, at times clients have their own doubts. So when we reach out to clients to request for data, they would say that we are right now worried about income tax, so we'll do that, and thereafter we'll do the GST audit. But the challenge which comes here is at our end also we have limited hands and limited hours which each person would have, and therefore if everyone comes in the last moment, it becomes very difficult for our organization to handle that type of the pressure. And in that pressure, when we raise queries, it becomes very difficult for even the clients or their teams to respond to those queries, and then unnecessarily a lot of pressure gets built up. And therefore I would earnestly request each one of you, wherever GST audit is applicable, let us try to make sure that within this 2 months period we even out the pressure at both the ends, at your end as well as our end, and make sure that the data flow is at a reasonably fast pace and query resolution is at a fast pace, so that we can ensure timely completion of the assignments. I had a very detailed discussion with our partners a couple of days back. We have drawn up, as an organization, we have drawn up a very detailed chart where we have done a fortnightly action plan for each of the team members in our organization. and the partners would reach out to you and request you for data and query resolution within a particular time frame, my earnest request to each of you would be to please respect those timelines. And if there are some genuine concerns, let's escalate it, and let's make sure that the communication channels are open as far as making sure that the GST audit timeline is complied with in the correct manner. That takes me to the last slide for today's discussion. And of late, we've seen that there have been lots of notices, communications, letters, emails from the department side. Suddenly, the department has gone in an hyperactive mode, and various challenges. The first challenge is today you have to deal with two authorities, and in service organizations it's not just two authorities, it's at least if you are registered in 10 states, 20 authorities, because each of the state is a separate registration. There is a center state jurisdiction, but we see that while some cases they are respecting that jurisdiction, in many cases they do not respect that jurisdiction, and that creates a lot of difficulties on a day-to-day basis. Notices are coming for GST audit, for scrutiny, for investigations, mismatch driven notices from the portal. Anti evasion teams are coming and questioning the interpretations and the classifications taken by you, and all these aspects are coming up. And all of this, there are strict timelines for responses to be given. At times, very unreasonable timelines are given, and there are very severe consequences. We have seen cases where things have escalated to the extent of attachment of bank accounts or blocking of input tax credits and ex parte assessments, high pitched ex parte assessments, and things like that. And therefore, I believe that this is a scenario where there's a lot of fluidity. Uh, I'm sure people would represent and industry bodies would represent to the government against this type of an department overreach or outreach. But in the meantime, I think it's important that all of us should be strong enough to handle these things well and comply with the requirements to the extent possible and handle it in a proper time management manner. So I think that's where I would want to end my discussions with. It has been around 45 to 50, 75 minutes since we've discussed. If there are any questions, people can put them on the chat box. I think there is one question which has been relating to government entity and the e-invoicing in case of government entities. So there can be three scenarios as I was discussing. If the government entity has a GSTN, it becomes a normal B2B, and you have to raise the invoice as an e-invoice only. If the government does not have a GSTN and he gives you a GST TDS number, then you will plot the GST TDS number and raise an e-invoice. If both those scenarios are not there, then you will raise a B2C normal invoice, because without that field, an e-invoice will not get generated, and this has been clarified in one of the FAQs given by the department. So I think both the queries are related to that. There is a query about what is meant by branch transfer of services. We have had a detailed sessions earlier. Branch transfer of service is a scenario where you have registrations in more than one state, and one state undertakes some activity for another state. Now, there could be two broad examples of branch transfers. There could be a scenario where an entity has decentralized billing, meaning when the end customer has invoice has to be raised, it is raised from the respective branches. A typical example would be a bank or a financial institution, where it would approach a bank branch in a particular state, and that state would raise an invoice to the customer. Now, for enabling all these services, the head office, the corporate office in Bombay, will incur n number of expenses. Now, those expenses will have to be branch transferred, because in this case, it will be viewed that the head office is rendering a service to the branch in form of providing a support service. Another example could be a case of an entity which has a centralized invoicing, but there are branches which act as post offices or couriers or just a support service. In that case, there will be a branch transfer of service from the branch to the head office. So depending on each business model and the nature of billing which the business has with external stakeholders, the stock transfer of service position will get implemented. There is a question about e-invoicing, that if the supplier does not comply with e-invoicing provisions, can the recipient claim input tax credit? The answer is no, because Rule 48 very clearly says that the tax invoice will be valid only if it is in the nature of an e-invoice. Therefore, you will not be treated as having a valid tax invoice, and you will not be able to claim the credit in case the supplier does not comply with the e-invoicing provisions. In this regard, please note that on the e-invoice portal, you can put the GST number and you can find out whether the supplier is required to raise e-invoices or not. You can also take a declaration from the supplier to make sure that he indemnifies you if there's some loss of credit to you on this account. One more interesting thing which the government has done is, on the e-invoice portal they have developed an app. You can download that app in your mobile, and if you point your mobile onto the digital image of the e-invoice, it can validate whether the invoice is correct or not. So therefore that's a very good feature which the government has given, and I would suggest each of you to download that, and whenever your vendors raise e-invoices, you can just scan those invoices and the data will come on your mobile of whether the invoice is correct or not. There's a question from Sarath of whether employee cost is covered within the concept of branch transfer. It is a fairly litigious point. In cases where input tax credit is available, we would advise you to go safe, include the employee cost and claim the charged branch transfer, and then claim the credit at the other end. Otherwise, there can be a long debate on whether employees cost should be covered within the concept of branch transfer or not. Yeah, there's a question from Ame. If you have collected advance on which is going to be in a particular financial year for an event to be held later, and thereafter there is a cancellation, whether we can refund the full amount? I would believe yes. Wherever there is an advance, the refund of the advance, there are no timelines for it, and therefore that should be fine. The next question is it correct that whether we do claim input credit less than GST or uh, yeah, so this is an important question, that how are we going to look at input tax credit matching on a month on month basis? I would agree that it has to be on a cumulative basis for a particular financial year, because it is so possible, it is very possible that there can be an invoice which the vendor has uploaded in April, but you have accounted it in your books in the month of May, and therefore you would want to claim the credit in May rather than in April. You can definitely delay the credit up to the September of the next year, but there is no means to prepone the credit. That is what I think the rule would impact you. Nikhil is asking a question whether we can know whether vendor is applicable for e-invoicing. As I highlighted, on the e-invoicing portal, there is a link where you can put the GST number of the vendor and you will find out whether e-invoicing is applicable to him or not. I think these are the questions which we had. It has been a wonderful exercise. I am aware that there was quite a lot of participation. In fact, throughout the session, the Zoom participation limit was exhausted, and I'm sure there would be quite a few on the YouTube link as well. Thank you very much, and please reach out to us for any further questions that you might have. Thank you. Stay safe, and have a wonderful evening.